Hello, this is Matthew Copley with Copley Financial Group, and today we're going to do a market update. I know it's been a very long time since we've done a market update, but we are going to cover some really important topics, including the big, beautiful bill. We're going to talk about economic data, and we're also going to talk about a potential bubble that has formed in the stock markets and how a crash could be coming and how we can protect you from that. It's been over a month since the last market update we recorded. It's been a real challenge here in the office. We have really had our hands full with a lot of issues all at once. Our team here has been focused on a lot of things. First issue is Inspired Healthcare, one of the companies that we work with that has a lot of real estate investments in assisted living, memory care facilities. They paused distributions on those investments, and so we've been investigating, trying to figure out when the distributions are going to get restarted, how that impacts our clients. If we have a client that is getting income from this investment, is there somewhere else that they can get income until the distributions are restarted? So it's been a big process dealing with that, and of course at the same time we are dealing with the big beautiful bill, which has had a huge impact on the economy, on potential tax reduction strategies, a lot of new things, new investment that we absolutely love because of the big beautiful bill, which we will talk about today. That investment, I had to fly back to Chicago, do some due diligence on that particular investment, so that took up some time, and so then we're finally here after 3 attempts to do this recording. Third time's the charm. We're here doing a market update today. Speaking of the big beautiful bill, this has had a huge impact on taxes, and so I do want to cover a few of the highlights on this and how it impacts you. First of all, the big change with this is it's not going to raise taxes. See, if we didn't get the big beautiful bill, tax brackets would have really shot up, and this would have caused a lot higher tax rates, a lot more taxes getting paid out. For example, the 22% bracket would have jumped to the 25% bracket. The 12% bracket would have went up to the 15% bracket. And so these kind of tax increases would have had a real negative impact on the economy. Obviously, people would have had a lot less money to spend. And so those are some of the changes that, the big change that we're seeing. Of course, the other is Social Security. We now have an additional $6,000 per person deduction from Social Security. This is going to create a big benefit for retirees that are collecting Social Security. However, the plan is phased out at certain levels. For example, a single person filing single, it's $75,000 a year. For a married couple, it is $150,000 a year. So in the event that you are at that level or above, it starts to phase out. And so those additional deductions that you get on your Social Security, you don't get to get those deductions. They start to phase out. The good news is it is a long phase out. So someone who starts to phase out, for example, a married couple at $150,000, they don't get completely phased out until $250,000 in income. So as long as you're below the 250, there is some benefit there for you. Obviously, if you're under the 150,000, there's a full benefit. But of course, people above 250,000 as a married couple or a single person above 150 is just not going to get any benefit from the additional Social Security tax deductions. The other big change in the tax bill, the big beautiful bill, is the increase in the SALT deduction. And so this is currently at $10,000. This is the cap on state and local taxes. This is like your property taxes, your income taxes you pay to the state of California. You get a deduction on that, but only up to $10,000. Well, the bill actually increases that to $40,000. So now people are not limited. This helps people in states that have higher income taxes, states like California, New York, and areas that have higher Illinois taxes. This doesn't benefit people in states like Florida and Texas and Washington that have no state income tax. But this is a big deal. It does completely phase out for people above $500,000 in income. So just be aware, if you are above that threshold, you are limited to the original SALT deductions. But this does create a little bit of tax relief for people in California, which is a lot of our clients. So that is good news on the SALT deduction. In addition to the SALT deduction, we've got oil and real estate investments now can get up to 100% accelerated bonus depreciation. This is a huge deal. This is going to create all kinds of tax offsets. I mentioned this with a new investment that we like a lot that creates a massive tax offset. This is one where you can put in $100,000 in an investment and get in the first year a $220,000 passive loss in year one on a $100,000 investment. This is going to be really beneficial to real estate investors, people that may have real estate gains, and it'll create an opportunity to potentially use this instead of a 1031 exchange. We now have options for people that have capital gains, large capital gains in real estate. Obviously, the 1031 is still a great option for those people, but these new tax offsets are an alternative and a great way to offset taxes. And of course, with the oil and gas investments, we now have some much larger deductions. One, for example, that we like a lot, created a 57% deduction in the first year. That deduction we expect to be now over 80% because of the new bill. So economic data is really mixed. When you look at the labor reports, when you look at a lot of the economic data, manufacturing, it's really mixed. We're not seeing a really strong economy. We're not seeing a really weak economy. There's a lot of mixed data, except there is one thing that I am very concerned about, and that is housing data. We are seeing some pretty negative numbers on housing. We're seeing a lot more properties up for sale. They're kind of lining up, they're not selling, and there are just no buyers. And I think the one issue that we have with this is the higher mortgage rates. We are currently, as of today, at 6.52% on a 30-year fixed rate, which is better than the 7.5% we had not too long ago, but it's still quite high. And when you look at income levels and those higher mortgage interest rates, people just can't afford to buy houses. And you're really seeing this in the differential between new homes and existing homes. An existing home is a home that someone owns that they're selling. A new home is a home builder that built a new home and they're selling it. The amount of concessions and reductions on the new homes is at a pretty big differential between existing homes, which means that we are seeing people that are buying new homes are getting a much better deal than people that are buying existing homes. This is typically not what you see in normal markets. And so this is really spelling bad news for the housing market. I do think that we're going to see a potential downturn in home prices. We're already seeing it in some markets. Here in San Diego, we are actually down 1%, not much. It's about the same as it was a year ago. But this is how it starts. You have this rollover in the markets, valuations start to come down, and at this point the Federal Reserve is, I think, too late on potentially lowering interest rates. We're already seeing this downturn in some areas of the country. Some counties in Florida are down more than 10%. We're seeing other areas of the country that are seeing some pretty big drops in home prices. And really what it just boils down to is there's just supply and demand. There's too many homes for sale. There's not enough buyers. They can't afford it at these high interest rates. Now, I don't think this is going to be a big crash like 2008, barring some major unemployment levels, going off the charts or something of that nature. But I just don't see a big crash. Back in 2008, you had a lot of these negative amortized loans, ninja loans, all these things. So you had tons of foreclosures. Those foreclosures hit the market, which really impacted home prices. Now, we could see a substantial drop in home prices, maybe in the neighborhood of 10 to 20%, not 30 to 40% like we saw in 2008. And not to mention, I think the government would actually act pretty quickly to any big drops in home prices would probably be met with a lot of quantitative easing, which we are going to talk about what the potential looks like for inflation in the future. But I do not like the data on the housing market right now. Now, the stock market returns have been absolutely fantastic, obviously over the last few years, but even this year, for example, the S&P 500 is up 8% on the year. So another positive year in the markets. Now, it's not doing quite as good as our client accounts. The Copley Tactical Fund's up about 16%. A lot of that has to do with our overweight to gold, which has done very, very well. We are focused on a lot of the inflation hedges within that account, and so we're seeing some really, really good returns on that. Gold prices, by the way, are way up. We're seeing the actual gold mining companies, some of these funds and some of these miners, they're up 40, 50, 60% on the year. And so we expected this. We talked about this in previous videos. I mentioned how gold miners are the way to go. They're undervalued. And of course, we are now seeing the result of a big increase in the gold miners. And I think they still have room to run. I really do. I think that the valuations are still really good. Even though you've seen a 50, 60% increase on some of these, I still think valuations are good based on current gold prices and what these companies are making in earnings. One of the real positive things that we've seen is what's going on with all of these tariffs. I actually am surprised. I was expecting to have more of an impact from these tariffs, more of a negative impact on the economy. Now, I've said before, and I'll say it again, tariffs are not inflationary. They are deflationary. In the event you have tariffs, what it does is it removes money from consumers' pockets that goes into the tariffs. And of course, they have less money to spend, which is deflationary. But we're actually not seeing that. We're seeing that only about 15% of the tariff cost is actually making its way to consumer prices. So this is a surprise. It's obviously a good thing for American consumers. We're seeing the majority of all of these tariffs at this point getting eaten by global trade, by people outside, exporters, and corporations are taking a hit on because of these tariffs. And the tariffs are actually creating a pretty good situation for the government. The government just released new data. This is data on how much money is coming in on tariffs and what the expectations are. And we are seeing an expectation of a $4 trillion reduction in the debts and the trade deficits and everything because of these tariffs over the next 10 years. That is a really big deal. So there's a lot of new revenue for the government, and it's really not costing the consumers much of anything at this point. Hopefully this will do what the tariffs were designed to do, which is spur more manufacturing inside the United States, which was the idea behind it. But at this point, we're not paying much more for these foreign-made goods, even with these tariffs. So it may have more of a muted impact on manufacturing here in the US. However, some of the trade deals that have been going through are resulting in lots of new investment in the United States, which obviously is very positive. We're seeing trillions of dollars in new investment, new manufacturing plants, new money coming into the United States. And these are deals that are being negotiated by the Trump administration and the government. One challenge that I think is a real problem, and this is something that I think is probably going to end up in the courts. I don't know how that this would be legal, but essentially Trump has taken a 10% position in Intel. This creates all kinds of problems. It really does. When the government owns a piece of a private company, it can create all kinds of issues. That company could be favored by the government with different contracts and things of that nature. And that's probably why Intel agreed to do this. Hey, we'll give you 10% of the company because ultimately we're going to end up with more government dollars. This creates a huge conflict of interest, and I just don't like the government owning any private companies. This is fascism. I don't like it. It doesn't work. It's not worked throughout all of history. So that has been obviously a challenge. I do like a lot of the tariffs and things that we're seeing the result of, but the U.S. government taking positions in private companies, not, I think, a good thing. We'll see how that plays out. Now, the biggest surprise, I think, is in immigration. This is something I did not expect. In fact, I've said on previous videos that when you deport a lot of illegal immigrants and you prevent people from coming to this country, it is going to create wage inflation because Americans aren't going to do those jobs that maybe someone that was an illegal immigrant would do that job at a lower wage. We're just not seeing that. Believe it or not, there's a lot of people that have actually been deported from this country, over 300,000 so far. Most of those are people with criminal records that have been deported, but now 1.6 million people have self-deported. These are people who just left the country, decided to leave. So when you compare or you add those together, 1.6 million plus over 300,000, we're getting up to 2 million less people. I would think that this would have an impact, but believe it or not, U.S. citizens are lining up for these jobs. We're seeing a lot of jobs that were being done by people that were here illegally that are now being done by people that are here legally. And so we have not seen a huge impact in wages. Now this can play out over time, so we could see more of an impact, which I expect over time, but so far so good. The immigration inflation has actually been, I think, a positive note, has not created too much inflation in wages, and it's creating more jobs for people that are here in this country legally. Speaking of inflation, one of the worst sets of data that we've seen recently is what's called the PPI, and I've talked about this in previous videos many times about the difference between CPI and PPI. What we see on CNBC and Bloomberg and all the financial news is we always talk about CPI, Consumer Price Index. This is the prices that consumers pay. And I've always said the one you want to look at is not the CPI, but the PPI, which is the Producer's Price Index, because that usually leads the CPI. And that's why in the past when I talked about how I thought inflation was going to go way up is because the CPI still looked low. This was back in 2022, and the PPI was really jumping up. We were seeing some big numbers in the PPI, and all of a sudden later on we saw big numbers in the CPI. And then of course I came on videos later and we saw that the CPI was really high and everyone's worried about inflation. It's at 9%. Oh my gosh. And then I said, wait a minute, look at the PPI. It's coming down. We're going to see inflation come back down. It's not going to be as high. And of course, this is what happened. Well, now we saw a blowout number in the PPI for July. This is a real problem. The expectation is this number would be somewhere between 0.1 and 0.4. We got 0.9. This is way up. None of the analysts even predicted this. And when you have a 0.9 increase in producer price inflation in the month of July, I mean, if you annualize that over a 12-month base, and I don't expect this every month, but if you annualize this is 10.8% inflation. This will affect the CPI down the line. I don't know what kind of an impact this is going to have and how quickly it's going to have the CPI, but that is a big concern when you see producer price indexes jumping up this much. And this could be something to do with tariffs. We're starting to see it filter through more. Obviously, at this point, we have seen very little impact on tariffs to prices, but this could be a sign that we are seeing more of an impact on this in the future. Of course, one of the big concerns is tariffs, I don't think, are really the inflationary issue. It's all the government spending. And this big, beautiful bill has a lot of government spending. So when you look at the amount of spending that is being done, we had all this Doge, this whole group, oh, we're going to cut waste, fraud, and abuse, the whole bit. Okay, great, we cut all this money. And then what did they do? They took all that money and gave it to the Pentagon, which is a giant black hole of waste, fraud, and abuse. So you have all of this additional government spending. This is what creates inflation. And you're seeing that reflected now in some of the producer price index, which is something I'm watching very, very closely. And so whenever you hear CPI, think PPI. What is that? Because that is going to be a leading indicator on what inflation may do in the future. Now, one of the concerns that we have is what the Federal Reserve is going to do. It seems like the Federal Reserve is more important than anything else in the economy. Everyone is watching what they're doing. Interest rates affect what happens with the markets, and they've really had a bad choice. The choice they had was we can not cut interest rates, and it's going to lead the economy into a recession, which I think has potentially already started, and this is a big concern that we have. Does this continue to get worse? Or does the Federal Reserve lower interest rates and potentially trigger more quantitative easing and allow the economy to continue to grow, but more inflation would be the result? And so this has been an ongoing battle. You've seen Donald Trump putting a lot of pressure on Powell and the Federal Reserve to cut interest rates. And so what he has done is he's found a way to get his way, and he just removed one of the Federal Reserve board members. This is going to have a huge impact. This is going to allow him to most likely have the votes he needs to get interest rates cut. Now, of course, the problem with this is that if you cut interest rates, they only affect the short duration interest rates. This could actually cause longer maturity rates to go up. And this is what impacts corporate borrowing and credit and mortgage rates, right? You could actually see the Federal Reserve lower interest rates and then mortgage rates go up from the current 6.5%. So the only way the government would be able to actually lower the interest rates in the areas that is needed would be to do quantitative easing. That's to actually print money out of thin air and buy those treasury notes to drive interest rates down. Of course, Japan has been doing this for years and years and years, and they've had a lot of problems with their economy, stagnation because of it. And so this is a real challenge. What do? Do you lead the economy into a recession, keep rates higher, or do you lower interest rates, try to goose the economy, make it grow, and then it cause a lot of inflation? Now, the current problem that everyone has is how much money we are spending already in interest expense, and it's quite high. It's going to be about $1.2 trillion this year. It sounds like a really big number, and it is. But it only represents about 22% of the government spending. We actually, believe it or not, had a higher number in the past. If you go back to the late 1980s and early 1990s, that actually reached 28%. And the reason that it was such a big number back then is because interest rates in the 1980s were really, really high. And of course, the debt wasn't as big, but because of the high interest rates, it was eating up a much larger portion of the government revenue. And so in this case, interest rates are pretty low, and we're still at 22%, which is still a pretty high number. The big concern is, what if interest rates go up? And this is a big concern. We have $37 trillion in debt at about 3.3%. That is what the government is paying. That's where the $1.2 trillion comes from. What if interest rates go up? Well, they already have. I mean, right now, when the Federal Reserve has to roll over and the Treasury Department has to roll over Treasury notes, what happens? They're paying a higher rate. And so as those get rolled over, we might be paying 4 or 5% interest at that time. And so this is going to trigger even a larger interest expense. And this is the big concern, is this cycle when you start to have to pay 1.5 trillion, 1.8 trillion, 2 trillion. Right now, all of a sudden you're in trouble, and we just don't have the revenue, and it creates a vicious cycle, and the debt, continues to go up. So that really has to get under control. And obviously the way to do that is to literally print the money, buy the Treasury notes, artificially keep it down. Now, of course, the government has to cut spending in order to prevent this problem from getting worse. We're not seeing that. It is a big concern. Hopefully we can grow out of it, maybe just keep the spending where it's at, continue to grow the economy. We kind of grow ourselves out of the problem, which I think is what the plan is by the current administration. I hope they can pull it off. One of the things that might be beneficial at some point is if they do start to lose control of the debt, what you do is you literally print up money, and instead of buying Treasury notes, you just buy gold with it. And of course, what this would do is help. Franklin Roosevelt did this in the 1930s. We know it works, but of course, this creates a lot of inflation. And either way, all roads lead to inflation. So we want to make sure that we hold assets, which we're doing, and it's one of the reasons we're outperforming. We're doing well on a lot of the stock accounts, is because we are focused on real assets. Things like gold, things like energy, things like agriculture, real estate, real assets that have real dividends and real cash flow. That's where you want to be, especially in an inflationary environment. I think inflation is going to continue to be a problem, especially if Trump gets his way and the rates come down and they realize not only do we have to lower short duration, but we also have to do QE, and this is going to create obviously a cycle. So we're paying attention to this, but we want to keep our inflation hedges on. We want to make sure we're invested in the right investments that are going to do well in this environment. One of the big bills that passed kind of under the radar that no one's talking about is the Genius Act. And this is something regarding cryptocurrency, stable coins. A lot of people are using this and saying, hey, the government is backing Bitcoin and Ethereum and XRP and all these coins, and everything's going to be great. Actually, if you read the Genius Act, I think this is a poison pill for a lot of the crypto industry. They put in a lot of provisions that allow for stable coins and allow for the growth of cryptocurrencies under the bank's control. And this is what's important for you to understand. They actually put in the bill that banks can issue stable coins and pay interest, but non-banks cannot. They can't pay any interest at all. That's part of the rules, right? And so this was intentionally put in to give banks more control of the crypto market and the stablecoin market. If you can have Tether that's backed 1-to-1 by Treasury notes and you're not getting any interest, or you can hold the Chase or Bank of America stablecoin and all of a sudden you're going to get a 3% interest rate on this, and they're both 1-to-1 backed by Treasuries, why would you own the one that you're not getting 3% interest on? You'd want to own the one that you're getting interest on. So what this has done is it's created an environment where the banks are going to get control of the crypto market using stable coins. I think this is going to roll out. I think they're going to be changing a lot of the systems here in place. I think that the banks want to get control of this market. The government wants the banks in control of this market. At the end of the day, the government wants to sell a lot of treasuries And one way to do that is to have all of these stable coins buy those treasuries to back those one-to-one. So this is a way to create a market for treasuries. It's a way for the government to have more control. Obviously, if everyone is running around with their cryptocurrency stable coins in their phone, the government might be able to track what people are buying, what they're doing, making sure they're paying all of their taxes. And so a lot of people are worried that that this means the end of cash, the end of anonymity, that you're not going to have anonymous purchases anymore. I don't think so. I think maybe in the future, depending on a new administration, that potentially could be a concern. But at this point, Trump's talking about a new $500 bill. That's cash. And having a newer $500 bill is going to create more currency out in the system that's not part of a stable coin. But again, you start to think about this is why would someone want to hold a $500 bill when they can have $500 in maybe stable coin that pays interest, right? And so there's going to be an incentive for people to use these stable coins. And obviously they're more convenient. They're on your phone. It's real simple. You're not carrying around a bunch of cash. And so this is how I think they're going to get us into the system. And of course, they'll have provisions in place where you can pay your taxes using these stable coins. You're going to be able to do a lot of things with these. And so I do think this system is going to be rolled out. I think the Genius Act is something that is allowing this to be pushed along. I do not expect the current cryptocurrencies to benefit from this in any way. In fact, I think they could actually be penalized. And some of these coins really have no use at all. There could be a case made for Ethereum that actually has use case out there. Maybe Monero, which is something that cannot be tracked. Maybe that has a use case. But some of these, I really don't see a big use case for Bitcoin other than it's the first in the market and people see it as a store of value, and if they continue to see it as a store of value, it may be there. Other coins out there like XRP and things like that, I know there's a lot of push and a lot of social media and stuff, and a lot of people are promoting these. I don't see any value at all in some of those coins. Now, of course, one of the big concerns that we have is valuations in the market is quite high. I'm a little nervous about where we're trading at as far as PE ratios, so that's something to be concerned with. And one way to get yourself out of the market and just get some guaranteed interest is to put your money in an investment that pays guaranteed interest. And so we currently have good interest rates. You think about what it was 3-4 years ago when you could get 1%. Today we get 5.75% on a 3-year or a 5-year MYGA. This is like a CD with an insurance company. Guaranteed interest, it's insured. So this is a great way to just sit back and collect some guaranteed interest. It's insured, you can't lose. 5.75%, it's a great deal. Now, if you want to have access to 10% of your money in the course of a year on that, you do have your interest rate reduced to 5.6%. We do have one available now on a 5-year at 5.62%, so a little bit slightly higher than the 5.6 on a 5-year with that 10% liquidity feature. But this is a great way to get guaranteed interest. And for those of you that want to earn more interest, obviously not insured or backed, other than backed by a corporation, we do have some private placements, and this is obviously for accredited investors. One I like in particular is the largest home builder in America. We can get over 10%. It's actually 10.5% returns with the largest home builder in America. Now, obviously, this carries more risk because that company is responsible for paying that interest, guaranteeing that interest. There's more risk of that company than potentially like a MYGA, which is fully insured. But it is the largest home builder in America, so pretty stable and safe, I would say. But that's a way that you can get 5.75 or even 10.5%. And of course, we do have several options now that are paying over 10% from some pretty good reputable sources. And so if you're interested in that, obviously you got to be an accredited investor in most of those cases. There are some available in the 8% range for non-accredited investors, so we can take a look at that. Again, that's where you want to get a little bit more interest than the guaranteed 5.75, and you're willing to take a little bit more risk backed by a stable company. So of course, my favorite investment has been for a long time is the buffered index portfolio, the BIP. We have a lot of our clients in these. We love these investments. This is a way that you can invest in the S&P 500 with a lot of protection. And the reason this is so important right now is the S&P 500 is in a bubble, okay? It is overvalued. It is a problem. We are trading at a 23 PE ratio, very, very high. From a historical standpoint, the market needs to drop about 30 to 40% to get back into historical averages. Now, that can happen with earnings going up over time, or it can happen with a stock market crash. One of those is going to happen, and so anyone who's investing right now directly in the S&P 500 index is making a huge mistake. This is extremely risky at these valuations. You do not want to own the S&P 500 on its own. You want to be in a buffered index portfolio. This is where you can go into the S&P 500. You get to go up with the S&P 500, but you've got some major protection on the way down. So the one we have currently available, not quite as good of a cap as we've had in previous market updates, and that's because the insurance is a little more expensive. A lot of people are seeing this potential risk and they're buying the insurance, and so that's why we're at where we're at. But it is an 18% cap. That's not too bad on a 2-year basis. When you look at 18%, that means we can make up to 9% a year. And that's still a pretty good return. It's typically going to meet our clients' retirement goals. And so having the ability to earn that 9% is great, 18% over 2 years. But in exchange for giving up everything above 18% on the way up, you ultimately get a 20% dual directional insurance policy. And this is a very big deal. So the way it works on the way up is if the market goes up, 10, 12, 15, 18%, you get the whole thing. If the market goes up 30%, you're only going to be up 18%. So in exchange for giving up everything above that 18, if the market drops anywhere from 0 to 20%, not only do you not lose, you make the inverse return. So if the market is down 10%, 12%, 18%, 19%, you actually make 10, 12, 18, 19. You make the opposite return. This is a really strong account. It increases your odds with stock market positive growth over a 100-year period of time. It moves it from a 73% probability of going up to a 94% probability. This is a huge differential. And even better, in the years that the market goes down more than 20%, if we have a 2-year time frame, the market's down more than 20%, that's very unusual, almost never happens. But if it did, you still get a 20% reimbursement. So if the market was, say, down 25%, you'd get reimbursed 20%. You'd only be down 5%. And so the reason that I like this investment right now, it makes a lot of sense, is current valuations are a bubble. And we're seeing this specifically because of these index funds like the S&P 500. One of the big concerns I have is, could we have a crash like 2008? Absolutely. I think that it's actually potentially a bigger risk today than maybe it even was in 2008 because of the way the market is structured. See, in 2008, when we had that big crash, about 50% of all of the investments out there were actively managed. About 50% were passive, like S&P 500 index funds. Well, that has changed. Today, if you look at the structure of those investments, about 75% are now passive and 25% are active. And so this is a potential problem. What that means is that 75% of the people are just buying the index. No one's looking at fundamentals. No one's looking at valuations. They're just buying the S&P 500. This is the cheapest way to buy into the market. So I just want to be cheap and have low fees. Great, let's do that. But the problem is that only 25% of the people are actually looking at the valuations and fundamentals. So if people start to sell, like they did in 2008, and the market starts coming down, ultimately there's not as many people that are going to buy back in at the right time. See, in 2008, when the market started crashing, half the people are looking at the fundamentals saying, hey, the market just went down a certain amount, we're going to buy back in now, right? And so there was this natural protection in the market because you got a bunch of people watching what's going on, and if it goes down far enough, they're going to start buying. Well, now so much of the market is passive. If we see a big crash in the market, it might just cause an even bigger crash because there's so much of the market is just passive right now. And so you should not own the S&P 500 index alone. Make sure that you protect yourself. The way to do that is the buffered index portfolio. It is an absolutely great way to own the S&P 500. And just because we're in a bubble, just because the market is overvalued, doesn't mean it's going to crash tomorrow. The market can stay overvalued for a very long time. So you don't want to sit on the sidelines and not do a whole lot. You want to actually go up with the market. You want to make money. you just want to have a protection in case the market really drops. And we don't know what the catalyst is going to be, but there's an old saying on Wall Street that is very, very important, is that the bull goes up the stairs and the bear jumps out the window. And that's because as the market is going up, it stair steps up, but when it drops, it just drops. And it goes very, very quickly. And this is a much bigger risk today than it has been in the past because of the current valuations. So the buffered index portfolio, right? And if you want total insurance, just get 5.75 guaranteed in the MYGA, but the buffered index is a great way you can make some higher rates of return and still have some really good protection. And how cool would it be if the market's down 15%, everyone's down 15, and you're up 15? That is what we call a 30% alpha. That is phenomenal. So it's a great investment in that case. And so I do think it's still one of my favorite investments, and we will continue to use this. And of course, most of our clients are in these investments. We like them a lot. And as these mature and new ones come available, we're going to continue to make sure that we're offering these to our clients going forward. Two investments I will highlight as I'm finishing up here. I do want to mention Alpine Capital Research. This has been a great investment for us. We haven't had as many clients in this investment as maybe I would have liked, and that's because their fees are much higher. They're actually the highest fee investment that we have available for our clients. It's actually 1% to us plus 1% to Alpine. That's a 2% fee. So in the event that the stock market, say, was up 10%, you'd only be up 8. If the market was up 15, you'd only be up 13. I don't like higher fees. Obviously, for some of our clients, higher net worth clients, we look at it and say, well, Alpine's got a really good track record. I think they're going to outperform. I think they're going to be worth those higher fees. And when we look at what they did from 2000 to 2010 in a very similar market environment, they performed extremely well. They were 10% a year higher than the S&P 500. Phenomenal returns over that decade. And so this is something we thought may continue to happen. So we put a lot of our higher net worth clients in this. It does have a $100,000 minimum to get into this investment, and it sure has performed well, up over 20% this year. Compare that to the 8% in the S&P 500. It's been a great return. Now, of course, 20% means 2% fees. You're only netting 18, but I would argue that it's worth that fee if you're getting 18% net after all your fees versus 8% in the S&P 500. I think that will continue. Alpine's got a great track record, very good value-oriented stocks. Really small number of companies, kind of the Warren Buffett, Benjamin Graham approach to investing. Small number of high quality companies that are undervalued, and they've got a great team that obviously you have to pay for in order to work with them. But I have a lot of my own personal money there. We have some of our higher net worth clients there. So Alpine Capital Research, it does have a higher fee structure. That's the initial pushback we get from people, is that it's a higher fee than the other stuff, but it may be worth it. So I wanted to highlight Alpine. The other one, of course, I want to highlight, and this one's a little self-serving, it's my Copley Tactical Fund. Obviously, we've done a great job. Much lower fees, by the way, even lower fees than some of the more traditional, like the Gradient 50 and other ones we've used. But the Copley Tactical Fund's done very well. We've got nice positions in inflation hedges, gold, energy. It's done very well. So we're actually up quite a bit. More recently, that's really taken off and done well, up about 16% on the year versus 8% on the S&P 500. So we're happy about that. We think that will continue to do well with those inflation hedges because, again, I said this before, all roads lead to inflation. We think that now that Trump has more control over the Federal Reserve, I think you're going to see lower interest rates, and when they don't get the longer rates coming down, they're going to do QE. They're going to force interest rates down. And the government needs this. You have all this debt. It's got to get repaid. You got this big interest expense. The government needs lower interest rates. Corporations that are potentially in trouble with refinancing need lower interest rates. Commercial properties that are on various loans, they need lower interest rates. Younger people are looking to buy their first home that can't afford it because the interest rates are too high. They need lower interest rates. And so this is what I think we're going to see. Now, a lot of you might argue, well, we just need lower home prices for those young people. Well, that would work too, but that could create a lot of recession, that could create unemployment, and so that could create a lot of problems in the event those home prices really drop. And so I think that the way that they're going to handle this is just they're going to force interest rates down. And so far, so good on the tariffs and some of these other things. So, maybe it will have not as much of an impact. Maybe I'm a little too concerned about what might happen with inflation, but we're definitely going to continue to monitor it. We're going to keep all of our good inflation hedges on, like our gold positions that have done extremely well, because I do think inflation is going to continue to be a problem. For anyone who wants more information on our investments, what we're doing for our clients, how we're helping people get more income, pay less in taxes, I do encourage you to reach out to support@copleyfg.com. That email, you get typically faster response rates because it's seen by a whole group of people here in the office. It's designed in a way to get fast responses. So in the event that you want to email me or email one of the advisors, include that support@copleyfg.com, because there is a team that's going to be pushing to communicate back to you on anything that you need. So again, support@copleyfg.com. Very, very good email address to use. And so I hope this was a good market update, and I appreciate all of you. And if there's any questions or concerns, feel free to reach out to us anytime. And I look forward to seeing you here in our Mission Valley office very, very soon.